I have never seen a market that is this divorced from reality.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I shouldn't say another. We've kind of missed some days recently. And I'm not here with the brain trust himself, Mr. Chase Taylor, because he is out of the office. Little family trip, I think, if I recall correctly. And then, like I said, we've missed some days. I've been out of the office traveling. Had meetings all day yesterday, so I couldn't do it. Anyway, so I feel like we haven't done this in a while. So a lot to catch up on. And yet at the same time, not a lot's changed other than the fact, and we'll get into the markets today. I'm seeing more and more people questioning this. And I will say this, taking out extreme circumstances, like the times right before and after COVID, the thing I think that is bothering me the most right now, and the thing that I think is the most unique. So let's look at it in terms, I think we have to be careful not to make markets too personal, meaning I think sometimes we just kind of sit back and forget to be spectators a little bit, right? It can be how it relates to us. Obviously you do this for a living. The only thing we're really focused on is the P&L, profit and loss, and making sure we're on the right side of it. But a lot of people listening to this probably don't manage money for a living. So something that I think that we need to be aware of, and it's not new if you've listened to this show, but also just to sit back and take it in. I think there's a lot to learn from the current environment, meaning I have never seen a market that is this divorced from reality. And by meaning that, I'm not saying one way I'm saying all around I look at things and the only thing I see consistently are things priced ridiculously far away from where they should be. You look at two companies in the same industry where one's growing at 20% a year, the other one's growing at 6, the other one growing at 6 or 7 is valued at twice the valuation as the one growing at. And obviously there's other things that could make that accurate, but I'm saying on balance. And I can show you example after example after example of this. This market is broken. Full stop. This market is broken in terms of what markets are supposed to be. And again, we've talked about this before, so it's just bizarre. Another example, this one's been crazy for a long time, but Tesla, okay? Tesla investors are scratching their head right now because they announced Q3 deliveries that were actually 7% higher than they were last year. The reason, though, you see those deliveries occurring, the reason you're seeing that pop in deliveries for Tesla is everybody's trying to outrun the EV credits running out. And so on a day, and this to me is a little bit of a canary in a coal mine, okay? On a day where Tesla announces that deliveries, and the headline was, blows away delivery. It was a 7% increase year over year. I don't know how that turned into blowout. But not surprising, meaning that the expiration of the EV credits, you would expect to see, throw that up there with any other automobile manufacturer this year. In this quarter, you should see at least their EV segment getting a pop. Now, what's interesting to me is that normally on a day where nothing positive is announced for Tesla, it can go up a lot. And when something is positive announced, it goes through the roof. Tesla's down 4%. Now, look, Tesla could be up 15% a week from now. So take it with a grain of salt. But why that's interesting to me is that's got some reality basing to it, right? Meaning if the expiration of those EV tax credits, and we're talking $7,500. Okay, so depending on the Tesla you're buying, it could be anywhere from a 10 to 15% rebate. Remember, that's a tax credit, straight up. And I believe the way that works, right? That's not a tax credit in the sense that they're going to cut your reported income by $7,500. It cuts your tax bill by $7,500, right? So you would think you'd see a greater than 7% pop. But my point in bringing this up is on a day like that, Tesla's down 4%. Now, again, a week from now, the idiots could push it higher despite, like I've said, I've never seen a company in more dire straits. Not dire straits as in they're going to go out of business, but in terms of Tesla's business is in worse shape than it's been at any point in the last 5 years. And they're facing potentially existential threats, meaning you got several Chinese-based manufacturers that are making better cars with better range, better features, better equipped at a far cheaper price. That's a problem. Better battery technology, better full self-driving technology. That's a problem. Now here domestically, we could pass things that could protect Tesla, but no other country is going. But why I said that's interesting, the stock's down, is it tells me yet again, I'm seeing more signs of fundamental awareness starting to show up. And here's that problem with valuation. You know, I know a lot of where I've seen and heard a lot of Tesla longs getting excited about this run it's been on, bouncing from the low 300s to where it's at. And I'm like, guys, that run that you're excited about is exactly why it's down 4% today. You're bidding up the multiple on a company whose business is contracting. I see a headline today. This idiot, he just is the gift that keeps on giving. Jim Cramer, now it's time to be getting bullish Apple stock when it's trading at the highest multiple it has in the last 20 years, you moron. And they're losing market share. And look, here's the deal. He might be right. The stock might go up. But as I've just said, that doesn't mean he's right. Meaning you can't look at that business in this environment at that valuation and come away thinking that thing is a buy. It is just not. Trading at 40 times earnings and growing low to mid single digits with 15% margins that continue to compress, losing market share, total lack of innovation. New phone they launched is trash. That company is garbage. And I know it's when I say that seems like an extreme position. I am saying the management, the execution, the innovation, they are garbage. And I wouldn't pay 18 times earnings for that crap. And that's not subjective. I mean, that is a bit objective. But what's subjective is not the business. Go look, every metric you look at is worse. And as it is declined, its multiple has doubled. As the reality on the ground has gotten worse, this thing traded in 15 years, in a range between 15 to 20 times earnings. Now, when it has no innovation, it's ceding market share. It's got the lowest smartphone market share since like 08 or 09, something like that. Margins have compressed, no innovation, no innovative products in how long? AI phone that was a complete joke that didn't materialize. I mean, over and over and over. It's like the gang that couldn't shoot straight. And that doubles the multiple. I saw another guy posted on Twitter today and he goes, I've been trading these markets since 93. And he goes, I've never seen anything like this, meaning you don't even need a narrative. It's just zero gravity. Just things are floating all over the place. Nothing is tied to fundamentals. And I'll just tell you guys, not making a market call one way or the other, I would be very, very cautious over the next 30 to 90 days. This has a nasty feel to it. I'm watching Bitcoin get a bid today out of the middle of this. That's unsettling to me too. It's like you have two different markets. And I kind of starting to feel like the pros are starting to exit and the only thing holding this up is retail. I could be wrong. That's what it's starting to look like to me. Now, here's the thing. And this is the part of the business that nobody ever wants to talk about. I could be wrong. And this could potentially be the beginning of a blow off top. Why do I say that? Because when you see these kinds of price appreciations go, and I've said this, we've talked about this before, but this is kind of the moment that I was looking for. You're at this break-even point where I don't think you're going to get a muted move here. I think you got to move big one way or the other. It's like we're going to go full idiot mode and completely detach, which if we do that and we see that blow off top action, you're very close to the end. Right. Because valuations, especially on a relative basis, are stretched so far. The fact that people are not talking about this, the fact that Jim Cramer's out there advocating for a pig like Apple, that you would step up and buy it at 40 times earnings. And I just saw another article that just typified what we're talking about. Can't remember the name of the stock, but it was sitting there. It was you start reading the headline of the article and it's like, oh, things are turning around. Things are looking good for this company. And it looks like there's a fundamental turnaround according. Now, I'm a believer in technical analysis. It's part of our process. I've often said that I think that where people can get led astray with technical analysis is I think it's a timing tool, not a security selection tool. Obviously, there are caveats to that and there are exceptions. But I've always said that I think technical analysis is very helpful in terms of timing buys and sells. Most of the time, I don't think it's very helpful in terms of figuring out what to buy and sell. But we're at a place now, and again, and I've made this joke repeatedly in the past, that at the top of market cycles, everybody is a technical analysis, and at the bottom of market cycles, everybody's a value investor. Why do I say that? Because at the tops, remember, markets, like everything else, markets are like human beings, meaning they always go too far in both directions, right? Because usually it's driven by the fundamentals, and then human emotion carries that fundamental response way too far, both to the upside and the downside. And I think looking here in the US, looking at this market by and large, it's not me sitting there saying that we have another financial crisis on the horizon, or you're about to lose 40% or 50%. It's just, I'll just continue to say it's just dead money on a fundamental basis. And getting back to the tough part about the business that nobody ever wants to say, that you're getting into a market where whether this market goes up or this market goes down, I obviously hope it goes down for several reasons, just because if it does go down here and we get some turbulence, A, we're positioned for it. So I'm speaking my own book. But B, also it means that however this resolves, it will be less bad. Meaning if you're going to get hit, you want to get hit before the blow off top happens. You hope that jars some sense back into investors, that they start paying attention to things like fundamentals. And the reason why is there has been no greater destructive force economically in this country over the last 100 years than asset bubbles. If you listen to people at the Federal Reserve talk, they'll say, well, inflation's too low and look, every single big economic implosion has never been caused by the stuff that the Federal Reserve is talking about. It has always been caused in the last 100 years by asset bubbles, by prices going too high. And here's why that's so destructive. It's so destructive because uniquely, collapses in asset prices can wipe out so much GDP and so much activity in such a short period of time. And more importantly, speaking in the long term, more importantly, the more expensive asset prices go, the worse they're going to perform in the future. And so what ends up happening is right before you get this massive destruction of capital and wealth in the collapse, you're loading up the youngest people with ridiculously high-priced asset prices. So what does that mean? It means that you're going to compound their economic difficulty in the eventual pullback. It also means that you're going to leave indelible scars that will make them less likely to deploy capital in the future, that will make them more disillusioned with what the American dream is. And I don't usually say this, but I have a very ominous feeling right now. Hopefully it's wrong. And, I don't even know whether I should say hopefully it's wrong, because I think the one thing this country needs is a recession, and it needs it so bad. And it does not mean that I do not care for the people that will pay a price during that recession. But when I hear people that are supposed to be financial professionals talking on the TV and saying, what we need is a lot of new housing being built, I sit there and look at them and go, you're an idiot. I don't understand how you got to the station you got to in life. Yes, if you can build a bunch of new houses without drastically increasing the demand on all the parts and all the individual, units that go into building a house, then great. Obviously you can't do that. But what I'm saying is if you get a bunch of new houses, but what do you think that's going to do to the price of building houses? It's going to push them higher. Why? Because you're going to push the costs up, right? The costs of all the inputs of the house are going to go up. It's like at some point over the last 20 years, our brains have become incapable of calculating the pain and the pernicious nature of inflation. You have to think about it completely different. What you need is a recession. And these are the problems that get started when human beings decide we know better than cycles, that we know better than the historic cyclicality of the economy. We have not allowed this economy to declutter itself for 15 years. So yeah, things are going to get weird. And one of the reasons why I'm not sitting here pounding the table and telling you to sell everything is because things are really weird. Would it surprise me? Yes, it would surprise me. It wouldn't shock me if somebody walked in the door right now and they said, look, Zach, you're right. It's going to go that way eventually, as we all know, but this market's going to double before it goes down. I wouldn't laugh them out of my office. I don't think you can take the possibility of that off the table. Why do I say that? Because whatever bad does happen, we know what the government response is going to be. So all of a sudden you get a recession, you get a big pullback in the stock market, and you think people like Trump are going to walk out there and go, the days of fiscal profligacy are over. We're going to get responsible. No, of course not. And it doesn't matter whether it's Trump or anybody else in the White House. Why? because the stock market has become one of the tenets that get you elected and president. We've decided that whoever drives asset prices up, we've also decided that all asset prices going up are good. Think about that. I don't know why that's good, unless you're just looking at it from your one perspective that you own a bunch of assets, so therefore it's good. It doesn't help out upward mobility in a market. It doesn't help the 28-year-old young couple that just got married start a family, right? What is the most beneficial thing to an economy? It's household formation. So what have we done over the last 15 years? What we've done at the cost of household formation is boost up asset prices for the people that have already formed houses. And when I say that, you go back to the baby boom days, right? You go look at the 70s and the 80s. Well, one of the biggest drivers of that, both the inflation and the growth and prosperity that we saw in the 80s, that always gets left out of these conversations, one of the biggest drivers was the baby boom. Household formation, right? All those baby boom kids, the biggest generation in the history of the country. Isn't it weird that one of the greatest growth periods in our country is when those people came of age, when they started forming households, when they started buying houses and cars and diapers and groceries? And then what have we done for the last 20 years? We've said, screw those guys, push up asset prices, because our new economic theory is that higher for longer is better for everything. The cost of upward mobility for younger generations. Now, when younger generations lose that upward mobility, guess what they also simultaneously lose? Faith in the American dream. You'd expect to see a rise in despondency, of cynicism, of skepticism. Does that sound familiar? So by avoiding the short-term pain of asset prices and 401ks going down 30 or 40%, you're endangering the future of the guys. It's something that we've got to rediscover in this country, is that there's no such thing as a free lunch. When you're kicking the can down the road by printing money you don't have to support asset prices just so you can get reelected, there will be a cost. And what do we know about delayed costs? They're the opposite of delayed gratification, right? Delayed costs just end up exponentially increase that cost. Delayed gratification does the opposite. Well, actually, it exponentially builds up that level of gratification. So I guess it doesn't do the opposite, but you get what I'm saying. And so rather than sitting back and prognosticating about which direction we think the markets are going to go, I think we need to ask ourselves a pretty hard question. Which way should we want them to go? And I don't know. I mean, actually, I do. Now, this is where I'm going to talk my own book. I want the stuff that I own to go up, right? Selfishly. But generally speaking, if you hear all the problems out there, here we're talking about too high prices, housing affordability, all of those things get better in a recession. Now, what's unique about that is that recession is not even as viable of an option as it was 10 years ago. Why? Because we weren't running 7% deficits back then. That's one of the scary things.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
You get in a recession, tax receipts are going to drop drastically. Well, think about tax receipts. Think about cap gains. Think about how much money people have made in the stock market. Think about what an infusion of tax revenue that has been. You're at 7% deficits. Like we've said, I don't think it's controversial to sit there and say, I don't think there's anything that's going to get the government to spend or operate on a sober fiscal footing. So if you go through a recession and tax receipts get hit, you could be at 11, 12% deficits that fast. Why is that scary? Argentina was dealing with effectively hyperinflation, and they were at 13% deficits. Why more people aren't talking about this? Like, this is not the conversation that we all grew up with, where, I remember back in the 80s, early 90s, yes, I was that weird kid, but I remember hearing about the debt and thinking about it was going up and, $1 trillion. How are we ever going to pay that back? And what happens is we've talked about this debt for so long that everybody's just anesthetized to it. And so what ends up happening is they lose sight of when your deficits go from 2 to 2.5%, which is sustainable. I mean, it's not good, right? You should run a balanced budget ideally. But the idea has been you can overspend a little bit as long as it's not too much. But now you're up at 7. And like I said, you're talking about flirting with third world status here. The only other time we've seen deficit spending like this is when we were on the gold standard and we were fighting a World War II. And so that wasn't even really spending. That was an investment that paid off very well, by the way. But the vast majority of this spending is just social spending. So there is no legacy benefit. I mean, people don't starve, which is like, I'm not blind to that, right? I get that. But what I'm saying is that there's no asset there, right? Like I've used the analogy of the Hoover Dam before, right? The Hoover Dam cost whatever it cost. The dividends that thing has paid is probably, I don't know, X the cost. I have no clue what it is, but I bet you I wouldn't be shocked at all if it was X the cost, the production utility we got out of it versus what it cost. Social spending, Medicare, that stuff doesn't work like that. You're just incinerating money. I'm not saying that we shouldn't support those things. I'm just saying we need to control the size of them because it's not investment in the way that infrastructure is. And then you bring it back to this market. I just, like I said, I hope I'm wrong. Selfishly in the short run, I hope I'm wrong about markets getting hammered. I just don't like this. I just don't like it. I've seen multiple days now with volatility creeping higher, even on days where the market's up. I'm watching increased erraticism and price movements that have no underlying explanation for it. And yet on a day like today, I also see Bitcoin up almost 3%, which is kind of a counterintuitive data piece because Bitcoin has really been the best gauge. Like the Bitcoin people are going to tell you, oh, it's all about currency debasement. Nonsense. Bitcoin has been a sentiment indicator. It tracks tech. It precedes it. It's been a liquidity indicator, which is why you've seen it move oppositely the dollar and opposite of gold so often. It's a liquidity indicator. Now, you can sit there and say that you think it's all these other things, and you can characterize it however you want. You can dress that pig up any way you want to. I'm just looking at the chart and telling you how it moves. And it moves like a double X, triple X levered triple Q fund, NASDAQ fund. So when I see signs of liquidity drying up out there and I see Bitcoin catching a bid on a day like today, that makes me nervous. But again, that could pretend for a blow off top too. My whole point in saying that is this. I think that now is the time for sober thinking. Okay. Could the blow off top happen? Yes. But now is the time for risk management. Is it easier said for us based on the year we've had up over 30%? Sure. But also more than that, if you've had a really good year too, protect capital. You and I don't think will happen this year. I don't think the stock market's going to run 15 to 18% to the end of the year, which means a guy like me sitting on 32% gains or whatever it is on the year. If you're worried about them catching, I don't think that's going to happen. As a matter of fact, I think the risks are much greater to the downside that you could get nailed here. But I definitely think it's a moment for sober thinking, to sit back and go, what am I buying? Does this make any sense on a rational basis? And this gets to the part of the job, and I alluded to this earlier, part of the job that nobody wants to admit, and that is there are times where the risk reward setup appears so negative that you have to willingly sit there and watch a market go up while you don't participate. Because if you don't, and if you're going to try to time this perfectly and you're going to try to ride the wave, there's very few people in the world that have the skill, the knowledge, and the makeup to be able to pull that off. I was telling another client an analogy today, and I go, let's say you're sitting on a big block of Nvidia. Now, mind you that this is a company that's moved up another 150 billion in market cap since they announced that their second largest purchasing client or country, China, that we estimate conservatively makes up about 30% of their chip demand, said no more Nvidia chips. Since then, it's gone up another 150 to $200 billion. What other business would go up with their second biggest client? Now, is it possible China was just saying that and they won't follow through? Sure, that's always possible. Wouldn't be the first time that Beijing lied to us. I don't see why they would. But here lies the problem. I've got several stocks in my portfolio that if they were to go down 20%, I know exactly what we'd do. We'd buy more because they're so cheap. It's like buying free cash flow. If Nvidia goes down 30%, what do you do? What do you do? It's too expensive to just surreptitiously and just automatically just jump in there and buy more, especially if they just lost 30% of their demand. And then when you look at how quickly they announced that ChatGPT deal, which was basically them just purchasing their own chips, that doesn't look like a company that's flooded with demand. I mean, call me crazy, but if you've got so much demand you don't know what to do with, you don't need to finance your customers so they can buy your product. And I think it's also, like I said, the timing of that is really interesting because I'm betting China, or I got to assume Nvidia knew that China was going to be pulling back on orders prior to them announcing it. I would assume that'd be the case. And then, they announced that deal the day or what was it, 3 days after China made that announcement or whatever. And we just completely ignored that China news, but we rallied the stock further based off that news. And if you're sitting there going, Nvidia is great, this has nothing to do with the quality of the company. It's the price you're paying for it. And that's the issue. And for those of you that, and I've used this analogy 100 times, for those of you that don't remember it, When Microsoft took all their flack, when everybody lost faith in like, what do you mean? You probably don't remember because you weren't plugged into it. But Microsoft was not the belle of the ball. From 2002 to 2012, it was the butt of jokes because the thing went sideways. What everybody forgets is over that 10-year period of time, Microsoft tripled their revenue. That's like an annual growth rate of like 22, 23%, tripled their revenue. And over that decade where they tripled their revenue, the stock went nowhere. Round trip. Why? Because when you bought it in 01, you were paying a price that already had all that future growth factored into it. And so what'd you do? You sat on dead money for a year. No, excuse me, for a decade. For a decade. So nobody knows what the market's going to do in the short run. And I 100% throw myself into that group as well. What I will say though, is we've had a pretty good record timing these pullbacks and things like that. I'm not telling you what's going to happen. What I'm telling you is I very much believe this period of time where you need to have the horses a little close to the barn, have some cash on the sidelines, have some defensive positions, and keep some longs, right? We don't have to play it one way or the other, but where you want to position yourself in an environment like, and I'd put it this way. Do you think we're closer to the end or the beginning of this market move? The longest bull market in U.S. history. 15 years. Are we closer to the end or close to the beginning? Okay, so as you get closer to the end, you pull some profit off. If you've got, like I've said 100 times, you got those big stakes in some of those big tech companies, cut them in half. Deploy the money elsewhere. I'd encourage you cutting them more than in half. Well, why would I do that? Take it up with Warren Buffett. What did he reduce his Apple position size by? 80%. He didn't do it because it's cheap. So I do not like this market action. I don't like the lack of narrative around driving it. I don't like the stocks that are moving. This feels to me like the sober players have left the casino and all you've got are the degenerates in there. And I don't, like I said, I don't mean like that means we're going to drop 40 or 50%, but we'll have to see. Just don't like the look of this. I don't like the setup. I don't like the valuations. I don't like the prices. That being said, I've been worried about this market for a long time. Like I said, we've been pretty good at timing these things. I look at everything is stretched. Everything is really stretched. And the underlying reality of this economy is moving the opposite direction. Not horribly. It's not collapsing, but these things are totally disjointed at present. And I was talking to some clients today that have some money on the sidelines. And I said, hold on. Let's see for the next month. Seasonality for October is always horrible. It doesn't mean it always goes down. It doesn't always do that, but the odds of it going down in October, and there's reasons behind that, but the odds of it having a nasty month in October are higher than other months. It's just been the way that future history's played out. And when you look at the run this thing has been on, and you look at the baseless reasons for it, this isn't earnings driven. This is all hype driven. As a matter of fact, the earnings have yet to materialize with a lot of these things. We're not seeing big earnings reflections in the AI play other than the chip makers. And like I said, that just warning shot from China, 30% of their chip demand, which I think will lead to more. Because why? What is China using instead of the Nvidia chip? If it works for them, it'll work for other people, especially if they're looking to save 80%. It's like we said from the very beginning, enjoy these margins with Nvidia. They won't last. Why? Because they can't. Meaning eventually there will be a chip that makes sense if you're only paying $10,000 for it as opposed to one you're paying $50,000 for. Yeah, it doesn't have quite a good a functionality, but you're paying 1/5 the price. So I would just urge caution here, guys. By and large, I think longs are in natural resources. I will say this, the sentiment, Jim Cramer put something out today that got me really excited. And he said, I have sold everything oil and gas related. Last time he said that, we made 200% on our energy positions. Killed it. If Mr. Lack of Fundamentals himself, Mr. Couldn't be more wrong, almost all the time Jim Cramer is saying that he no longer has oil and gas, that makes it extremely attractive to me. So right now, I'd be looking in places where people aren't. I'd be looking for balance sheets. Why do I like oil and gas here? Because even if you get economic weakness, I think you're in a position with oil and gas. If the price drops much lower, supply is going to constrict. People aren't going to be pushing out as much of it. And I think that can probably take care of itself. But I like to buy things when they're cheap. And when Jim Cramer in this market, remember Jim Cramer, when is he talking about buying Apple after it's run up 40% and it's trading at the highest valuation it's been at in the last 20 years? When does he want to sell oil? when it's at the bottom. This is the same guy that said oil was uninvestable at $20 a barrel. So I'm full tilt in that camp of being a contrarian. Yes, there are things we'll buy. It's not the stuff you guys are looking at. It's not where we're interested. So anyway, that'll do it for us today. I got to run, but we'll see the way this plays out. I think the next week's going to be interesting, one way or the other. Because I think we are on the cusp here. I think we're either going for a blow-off, full, ridiculous blow-off top, or I think we're on the verge of some volatility. And I think we'll probably know pretty shortly. At this point, I'm leaning on the volatility side for a whole host of reasons. Nothing would surprise me. So stay limber, stay spread out, diversification, have some cash on hand. I think some hedges here within reason are appropriate, but just have some cash at the very least to be able to take advantage of some of these things. You don't have to get every bit of every run up. Manage the risk. Downside makes a much bigger impact over the long term than upside. Sometimes not losing is winning, right? Manage that risk. Anyway, you guys have a great evening. Oh yeah, markets. S&P finished up right around 0.25, 0.3. NASDAQ finished up right around 0.5. Fairly uneventful day. Gold made a new all-time high, but then pulled back. Other than that, not a lot going on. But like I said, you're playing at this area. I think you got to move one big way bigger. You got to move big one way or the other. I think we should probably see what some resolution to that would be my guess in the next week or two. So we'll see how it plays out. Until then, have a wonderful evening. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.